You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I know, yesterday I told you that we would discuss the mechanic behind high-yielding companies and high-distribution companies. But unfortunately, I forgot that Bank of Canada had other plans yesterday. So I had to do this show. So we're going to talk about the mechanics. Don't worry about that. It's going to be next Monday on the 28th. So the show is recorded. You don't have to worry about it. I have not forgotten about you. But today we have to talk about the big news that we had yesterday where Bank of Canada cut rates by 50 basis points going to 3.75%. So we're going to talk about the implication here. So first things first, good news, I guess. We finally beat inflation, or so it seems so far. So inflation rate in September was 1.6%. So we can see that as a pretty good news. So then Bank of Canada just said, you know what? Let's cut down rates to stimulate the economy again. Number one implication here, unfortunately, this means that we are going to continue to have a weak Canadian dollar versus the USD. Until the election is gone, until the Fed put a clearer message. Right now, we're trading at what, like $1.38 for a dollar? That's pretty weak, right? I'm not expecting that it's going to move that much. I'm not an expert in Forex anyway, but yeah, so be just accustomed to have a weakened dollar versus the USD. That's pretty much the thing. Second good news, I guess, it's for your mortgage and the mortgage wall. So first, your mortgage. Well, of course, if you're about to renew, well, any cuts is a good cut, right? So that's a good sign for you. You're going to have like more money in your pockets, and that's great. It's also great for Canadian banks because some of them had the brilliant idea to offer variable rates, but not increase the payment enough to cover when the variable rate increases very fast. So we do have banks right now that within their loan portfolio, they have clients with mortgages that are right now increasing because their payment is not enough to cover the variable interest rate they charge. At renewal, it's going to hurt. This is what we call the mortgage wall. Good news here, the more we cut the rate, I always have to think about like cutting the dividend, right? But the more the Bank of Canada cut rates, the smaller the wall will be. So it may not hurt that much. It's not going to put banks in jeopardy anyway, but still it's a good news overall. Another good news, of course, is for companies with higher debt level or like strong interest charges in their financial statements. Well, it's good news because now they're going to pay a little bit less when they will renew their interest rate. Or actually, it's probably going to be higher than it was before, but not as high as if they would have renewed their loan a few months ago. So those are the good news. So you're going to pay less as a consumer. Companies that are capital intensive are going to have a little bit more of a breather here. So that's great, right? Now we have a few bad news though. When you have interest rate cuts, it's not because everything is going well. So you have to consider that moving forward. It means that the economy is not expected to grow that much. Actually, Bank of Canada said that the GDP, the economic growth of the country, was 2% for the first half and expects a slowdown, so a growth of 1.75% for the second half. So, of course, we are a big country, an industrial country, so growing at 2% is not the end of the world, but it's still not super great. The next bad news is consumers are still strapped. They still have to deal with the impact, the long-lasting impact of this inflation rate period, where everything cost more today than it was 5 years ago, and that's going to stay the same. So consumers are still paying a higher interest rate, and now they have more money that goes to buy any type of goods because inflation has played its role. perfectly so far. Unemployment rate is soft. The unemployment environment is soft with an unemployment rate of 6.5%. So that's also another bad news, and that's also a reason why the BOC decided to cut rates, is to stimulate employers and maybe tell them, yeah, you might want to hire more people. So now you have to spend less on interest charges. Maybe you have a little bit more room to hire a few more employees. 6.5 rate unemployment, 6.5 unemployment rate is not the end of the world, but is not near full employment either. We don't want to see that number keep going up, and this is another reason why the Bank of Canada decided to act on their interest rate. Another bad news, unfortunately, there is another reason why inflation has slowed down, and it's because we have excess of supply for a lot of goods. So throughout the economy, we have a lot of companies that had too much supply, and of course what they did is ran promotions, like trying to liquidate a good as much as possible, so putting some pressure on the price. That helped reduce inflation, which is great in one sense, but on the other, it also means that companies have a hard time growing their sales and selling their stuff. So it's not necessarily incredibly good news either. You have to take that with a grain of salt. I mean, I'm happy because I'm paying less interest, but on the other side, I'm well aware that if we have like consecutive rate cuts like this in 24, it's because the economy is not rosy in pink, is not pinky, and there's no unicorns flying all around, right? So I don't expect a lot of sales growth for most discretionary expenses going forward, especially for the next 2 quarters. It's going to be a bit tough for those companies. I know a lot of investors ask, well, which kind of move can I make now that interest rates are lower? Well, unfortunately, those moves, you should have done them at the beginning of the year, or actually at the end of 23, where I discussed this a few times in 23, saying, you know what, now we have like signs that we're done with interest rate increases. The next step, we're going to have a plateau, and eventually we're going to have cuts. So you have to make those moves at that time. Today, it was pretty much priced, so I don't see like any major movement yesterday when there was an announcement for my portfolio. So like investors did not rush rapidly to invest their money. There's still a lot of money in liquidity, so cashable GICs, short-term GICs, or high interest rate savings accounts. Those interest rates accounts are going to pay you less starting today, probably. So that's also not so much of a good news. So going forward, I don't expect to do anything with my portfolio different. I'm just wanted to share with you the news. Actually, it's going to have like a bigger impact on personal finance if you have debt than anything else. And for the economy, it's not necessarily the best news ever. But I don't know. As a consumer, we love cheap debt. As a business, we also love cheap debt. So I guess it's not that bad, right? All right, Moose, that's enough for today. Let me know if you intend to make any different moves, or maybe you're going to say, well, now interest rates are lower, the GICs, the interest rates on my savings accounts are like not very interesting, so I may move back a little bit more money. So go on YouTube, tell me what you're gonna do with that news, and I'm looking forward to chatting with you. All right, guys, take good care, and we're gonna talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.